Bismillahirrahmanirrahim. This is the first video on fraud, internal control, and cash. In this video, we will define fraud and internal control. We will identify the principles of internal control activities. We will explain the application of internal control principles to cash receipt. And finally, we will explain the applications of internal control principles to cash disbursements. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with what is fraud. So fraud involves deceit for personal gain or to harm others. The three key factors are opportunity, that is weakness in systems or controls allow fraudsters to act unnoticed. Desire for financial or non-financial gain drives fraudsters, and fraudsters justify their actions, making it easier to overcome ethical barriers. Addressing these requires strong controls, understanding motivations, and promoting ethical behavior. In the United States, publicly traded corporations must have reliable internal controls. Executives and boards must ensure their effectiveness. Independent auditors must confirm this. SOX established PCAOB to oversee this process. Internal control methods within a company achieve several goals like protecting assets, locks, alarms, and surveillance secure physical assets, controls and duty separation limits unauthorized access, regular checks ensure accurate asset tracking. Then improving accounting accuracy, that is softwares reduce errors and automates tasks. Documentation and approvals create clear audit trails. Reviews promptly correct and discrepancies. Then boosting operational efficiency, that is simplified workflows remove unnecessary steps. Metrics track performance and highlight areas for improvement. Training equips employees with necessary skills. And then finally, ensuring legal compliance, that is policies and procedures ensure adherence. Audits verify compliance regularly. Training ensures staff understand legal obligations. So these methods support asset protection, accurate record keeping, efficient operations, and legal compliance. Internal control has 5 main parts, each crucial for managing risk and governance. Number 1 is that is control environment. It sets the tone for ethical behavior and accountability. Risk assessment identifies and analyzes potential risks to achieving goals. Control activities, that is policies and practices that mitigate risks and achieve objectives. Information and communication ensures timely and accurate sharing of relevant information. And finally, monitoring, that is regular assessment to ensure controls are working effectively and to identify areas for improvement. So these components together create a robust system that protects assets, ensures compliance, and helps achieve organizational goals. Internal controls are important for an effective financial reporting system. The same is true for sustainability reporting. So investors, they care for about sustainability information because of risk management. That is, sustainability issues can affect a company's financial performance, long term value. That is, sustainable practices can lead to lasting success. Regulatory compliance, that is, companies must disclose their environmental and social impacts. Stakeholder expectations, that is, investors want transparency and accountability. Access to funding, that is, companies with strong sustainability performance attract more investment. And competitive edge, that is, sustainable practices can set companies apart in the market. So, in short, sustainability data helps investors make smart decisions that consider both financial and societal impacts. The principles of establishment of responsibility means limit access, that is, only authorized personnel should access resources or sensitive information to prevent misuse. Identify personnel, clearly assign responsibilities to specific individuals to ensure accountability and clarity in roles. Following these principles enhances accountability, reduces errors or frauds, and ensures efficient task performance. The principles of segregation of duties entail division of tasks, assign different individuals to related activities to prevent conflict of interest or errors. Separation of responsibilities, that is, ensure that the person responsible for record keeping of an asset is distinct from the one who physically handles that assets. By adhering to these principles, organizations can reduce the risk of errors, fraud, or misuse of assets by ensuring checks and balances in their processes. Documentation procedures involve pre-numbered documents, that is, use sequentially numbered documents to track transactions systematically. Prompt document forwarding, that is, employees should quickly send source documents to the accounting department for recording. So these principles ensure accurate and transparent financial records. Physical control involves secure storage, that is, keep the assets in locked areas like cabinets or warehouses. Restricted access, that is, only authorized personnel can access assets using locks, keys, or cards. Surveillances, that is, use cameras and alarms to prevent theft and monitor activity. Regular inventories, that is, periodically count assets to ensure that they are where they should be and in good condition. So, implementing these measures help protect assets from theft or damage, ensuring their safety and integrity. The principle of independent internal verification means regular checks, that is, records are reviewed periodically by someone independent of the process to ensure accuracy. Then report discrepancies, that is, any mistakes found during checks should be reported to management for fixing. Following this principle improves internal control, reliability, ensuring accurate financial reporting and reducing the risk of errors or frauds. Then human resource controls manage risk related to employees. Uh, Bonding ensure employees handling cash to prevent theft. Duty rotation and vacation, that is, rotate duties and require vacations to deter fraud. Background checks screen potential employees to trustworthiness. These measures reduce internal fraud risk, protect assets, and foster trust in the workplace. Let us make an anatomy of a fraud. Now, Maureen Frugali was a training supervisor for claims processing at Colossal Healthcare. As a standard part of the claims processing training program, Maureen created fictitious claims for use by trainees. These fictitious claims were then sent to the accounts payable department. After training claims have been processed, she was to notify accounts payable of all fictitious claims so that they would not be paid. However, she did not inform accounts payable about every fictitious claims. She created some fictitious claims for entities that she controlled. That is, she would receive the payment and she let account payable pay her. So the total take was 11 million in this fraud. So the missing control here is establishment of responsibility. The healthcare company failed to establish clear responsibility for authorizing and approving claims transactions. The training supervisor should not have been allowed to create claims in the company's active system. Now, Lawrence Fairbanks, the Assistant Vice Chancellor of Communications at ISOP University, was allowed to make purchases of under 2,500 for his department without external approval. Unfortunately, he also sometimes bought items for himself, such as expensive antiques and other collectibles. How did he do it? He replaced the vendor invoices he received with fake vendor invoices that he created. The fake invoices had descriptions that were more consistent with the communications department's purchases. He submitted these fake invoices to the accounting department as the basis of the journal entries and to accounts payable department as the basis for payment. The total take in this fraud was 475,000. The missing control is segregation of duties. The university didn't separate the purchasing tasks properly. Lawrence was involved in ordering, receiving items, and handling invoices. This allowed him to manipulate documents like substituting a fake invoice because he had control over the entire process. So, segregation of duties can help in preventing fraud. Okay. Now, Angela Bor was an accounts payable clerk at Agassiz Construction Company. She prepared and issued checks to vendors and reconciled bank statements. She perpetrated a fraud in this way. She wrote checks for costs that the company had not actually incurred, fake taxes. A supervisor then approved and signed the checks. Before issuing the checks, though, she would white out the payee line on the check and change it to personal accounts that she controlled. She was able to conceal the theft because she also reconciled the bank account. That is, nobody else ever saw that the checks have been altered. The total fraud amount was 570,000. So, the missing control is segregation of duties. As Agassiz Construction Company record keeping wasn't separated from physical custody, Angela had control over both the blank checks, physical custody, and the record keeping responsibility for preparing the bank reconciliation. This allowed her to manipulate the checks and conceal her actions. Okay. To support their reimbursement request for travel costs incurred, employees at Mod Fashion Corporation's design center were required to submit receipts. The receipts could include the detailed bill provided for a meal or the credit card receipt provided when the credit card payment is made or a copy of the employee's monthly credit card bill that listed the item. A number of the designers who frequently traveled together came up with a fraud scheme. They submitted claims for the same expenses. For example, if they had a meal together that cost 200, one person submitted the detailed meal bill, another submitted the credit card receipt, and the third submitted a monthly credit card bill showing the meal as a line item. Thus, all three received a $200 reimbursement. The take was 75,000 in this case. So the missing control is the documentation procedures. Mod fashion should mandate the submission of original detailed receipts instead of photocopies or credit card statements. Additionally, they could enhance documentation procedures by enforcing the use of corporate credit cards for all business expenses rather than personal credit cards. At Centerstone Health, a large insurance company, the mail room each day received insurance applications from prospective customers. Mailroom employees scanned the applications into electronic documents before the applications were processed. Once the applications are scanned, they can be accessed online by authorized employees. Insurance agents at Centerstone Health earn commissions based upon successful applications. The sales agent's name is listed on the application. However, roughly 15% of the applications are from customers who did not work with a sales agent. Two friends, Alex, an employee in record keeping, and Parvez, a sales agent, thought up a way to perpetrate a fraud. Alex identified scanned applications that did not list a sales agent. After business hours, he entered the mailroom and found the hard copy applications that did not show a sales agent. He wrote in Parvez's name as the sales agent and then re-scanned the application for processing. Parvez received the commission, which the friends then split. The total amount of fraud in this case was 240,000. So the missing control is the physical security. The Centerstone Health should have locked the mailroom after hours and controlled access during business hours. Also, they needed better authentication controls for accessing scanned applications. Since employees' passwords were the same as their users' IDs and known to all, unauthorized access was possible. Bobby Jean Donnelly, the office manager for Mod Fashions Corporation Design Center, was responsible for preparing the design center budget and reviewing expense reports submitted by design center employees. Her desire to upgrade her wardrobe got the better of her, and she enacted a fraud that involved filling expense reimbursement requests for her own personal clothing purchases. She was able to conceal the fraud because she was responsible for reviewing all expense reports, including her own. In addition, she sometimes was given ultimate responsibility for signing off on the expense reports when her boss was too busy. Also, because she controlled the budget when she submitted her expenses, she coded them to items that she knew were running under budget so that they would not catch anyone's attention. The fraud in this case was 275,000. And the missing control is independent internal verification. Bobby Jean's boss should have conducted regular reviews of her expense reports. When questioned about his estimate of her expenses for the year, he stated about 10,000 significantly lower than the actual 115,000. However, due to being too busy to verify expense reports or reviewing the budget, he overlooked the discrepancies. Okay. Now, Ellen Lowry was the desk manager of Josephine Rodriguez, was the head of housekeeping at the Excelsior in a luxury hotel. The two best friends were so dedicated to their job that they never took vacations and they frequently filled in for other employees. In fact, Miss Rodriguez, whose job as head of housekeeping did not include cleaning rooms, often cleaned rooms herself just to help the staff keep up. Ellen, the desk manager, provided significant discounts to guests who paid with cash. She kept the cash and did not register the guest in the hotel's computerized system. Instead, she took the room out of circulation due to routine maintenance instead she took the room out of circulation due to routine maintenance because the room did not show up as being used. It did not receive a normal housekeeping assignment. Instead, Josephine, the head of housekeeping, cleaned the room during the guest's stay. The total take was 95,000. And the missing control here is human resource controls. If the Excelsior Inn has done a thorough background check, they would have found out about Ellen's past fraud accusation and probably wouldn't have hired her. The fraud at the hotel was only discovered when Ellen was absent from the work due to illness. Having a system of mandatory vacations and rotating days off could have helped catch the fraud earlier. Okay. Why would unsupervised employees or employees who report to each other represent potential internal control threats? Now, unsupervised employees or those reporting to each other can create internal control risks like collusion. Without supervision, employees might team up to commit fraud, making it easier to hide. Conflict of interest. Reporting to each other could lead to biased decisions or favoritism, especially in tasks like expense approval or cash handling. Lack of oversight, that is, without supervision, there is no independent check, increasing the chance of unnoticed errors or policy violations. Reduced accountability, that is, employees may feel less responsible without supervision, potentially disregarding protocols. To address these risks, proper supervision, segregation of duties, and independent review are vital. The limitations of internal control boil down to three key points. First is the cost versus benefit. That is, internal controls can be pricey, especially for small businesses. They need to justify the expenses by effectively reducing risk and boosting efficiency. Human factor controls rely on people, which means they are prone to errors, negligence, or even deliberate wrongdoing. Even the best controls can fail if employees don't follow procedures or if there is collusion. Business size, that is, the size and complexity of a business, affects how controls are implemented. Smaller businesses may struggle with limited resources, while larger ones might find it tough to maintain consistency across departments. So, businesses need to find a balance between effective control and managing cost and human factors. Cash receipt controls ensure security, accuracy, and integrity. Like responsibility, assigning specific rules for handling cash keeps their things clear and accountable. Uh, Documentation, that is, clear procedures for recording all transactions, ensure transparency. Segregation, that is, dividing duties among different people, prevents one person from controlling everything, reducing errors and fraud. These controls make sure cash receipts are handled accurately and securely. Then cash receipts controls ensure accuracy, security, and integrity. Human resource controls use background checks and bonding for staff. This ensures reliable handling of cash. Physical controls employ locked cash drawers, safes, and surveillance. These deter theft and ensure security. And then independent verification, that is regular audits by separate personnel, ensure accuracy and detect fraud. These controls make cash handling secure and reliable. For over the counter receipts, it is important to separate handling cash from recording transactions. This way, the person taking the money isn't the same as the one recording it. This split reduces errors or misuse, making the process more secure. For mail receipts, cash receipts control include dual custody. That is, two people should open the mail receipts to prevent one person from having exclusive access to funds, reducing the risk of theft. Endorsement, that is, checks should be endorsed with for deposit only to ensure they are deposited into the company's account. List preparations, make a detailed list of the mailed contents. Each clerk signs to establish responsibility, enhancing accountability. Distribution, that is, original list and checks go to the cashier for deposit with a copy sent to accounting for recording. Clerks, they keep a copy. So these controls ensure security and accuracy, preventing fraud and ensuring correct recording of transactions. Then cash disbursements controls are more effective with electronic or check payments instead of cash for reasons like documentation. That is, electronic and check payments create clear records of the transaction, aiding in record keeping and audits. Authorization, these methods usually require approval before processing, reducing the risk of unauthorized transactions. Segregation of duties, different people are typically involved in approving, preparing, and authorizing these payments, preventing errors or fraud. Applications of cash disbursement control include voucher system controls, that is, numbered vouchers ensure accurate and legitimate payment with proper authorization. Petty cash fund, even for small expenses, controls like detailed receipts and regular reconciliations enhance accountability. So, by using electronic or check payments and implementing controls, companies can enhance their internal controls, reduce fraud risks, and ensure financial transaction integrity. Cash disbursement controls are crucial, and here how they work. Say, responsibility, that is, assign specific individuals to handle cash disbursements, ensuring accountability and reducing unauthorized transaction. Documentation, that is, implement detailed procedures for recording all disbursements, aiding transparency, audits, and error prevention. Then segregation of duties, that is, divide responsibilities to prevent one person from controlling the whole process, reducing fraud risk. Following these principles strengthens controls, safeguarding against financial losses or misuse. Then cash disbursement controls are crucial for financial security, and here is how they work. Independent verification, regular internal audits ensure accuracy, reducing errors and fraud. Human resource measures, background checks and training minimize misconduct risk, ensuring trustworthy staff handle disbursements. Physical safeguards, that is, locked storage deters theft, protecting cash and documents. So these controls strengthen cash disbursement processes, promoting accountability and reducing financial risk. Then cash disbursement controls like a voucher system make sure expenses are authorized and documented correctly. Approval network, that is people with authority independently approve each check, reducing the chance of unauthorized spending. Voucher creation, that is every expense gets recorded with a voucher, noting details like purpose and amount. This keeps a clear record for auditing. These controls boost accountability, transparency, and accuracy in cash disbursements. Okay. Now, how can companies reduce the likelihood of fraudulent disbursements? So, to reduce the risk of fraudulent disbursements, company can segregate duties, that is, divide the task among different people involved in disbursements to prevent one person from controlling everything. Strengthen controls, implement thorough documentation, regular audits, and multiple approvals for big payments. Verify vendors, that is, check vendors' legitimacy before paying them, keeping lists updated and double checking details. Review and approve, that is, enforce a strict process for reviewing and approving payments, requiring proper documentation and authorized signatures. Train employees, that is, educate staff on fraud, ethics, and company policies regarding disbursements, encouraging them to report any suspicious behavior. Then, monitoring regularly, keep a close eye on disbursement activities through regular monitoring and audits, watching for any unusual pattern. Use of technology, that is, employ accounting software, automated approval systems, and electronic payments while ensuring data security and restricted access. So, by simplifying these steps, companies can bolster their internal controls and thwart fraudulent disbursements, safeguarding their finances and reputations. So, this completes the first video on fraud, internal control, and cash. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.